Holly, you have to wonder, with such a sizable rally, if we are near the beginning of the end.
I think people would like to think that, Sarah, but we don't at Neuberger. This is nothing different, I don't think, than the rally we had this summer. People like to hang on to good news. We had a good jobs report this morning that continued the rally that we saw from the open, but we're not going to have a recovery in this market until the Fed signals that they're going to stop raising rates. And that's not going to happen until inflation starts coming down.
So I'm not that surprised to hear you say that, because you have been on with us before saying you're defensively positioned.
Yes.
Stick with quality. The thing is, and so the jobs report you mentioned, the JOLTS showed 1 million fewer openings than where we were last month. That's what the Fed wants to see. So maybe there's some progress. Manufacturing was weak this week.
Well, hopefully there's some progress. They've been raising rates the fastest they have in the last 40 years. So eventually it's got to have an impact, a desired impact on the market, so we can see those inflation numbers coming down. But, you know, like we've discussed before, there are opportunities in the market today. We do want to be defensive, and we want to position our portfolios today so that they can really take advantage of the recovery when it happens.
You're just not ready to go there yet.
No, this market has seen 35 moves of 2% or more this year.
That's crazy.
That's compared to 7 such moves last year. I mean, that's insane. So this market is volatile. That's the theme of 2022, and it's going to continue to stay volatile.
So where defensively are you positioned?
So we're still underweight equities, but we're seeing a lot of opportunities in the fixed income space. Short duration munis, you can get yields that are almost competitive with equity returns after tax, close to 5%. This year, we've taken our high yield allocation and invested it in floating rate funds. That's been a great defensive play, down only 4% versus the high yield market, which is down 15%. But now high yield bonds are yielding about 8%, and we're going to strategically move back into that asset class. We are focusing on quality in equities, and you can find quality stocks in every asset class, even in technology. There are chip makers that are trading at 30 times, and there are chip makers that are trading at 10 times. So we will say active management is key, fundamental analysis to buy the stocks that are going to be good value today and positioned to outperform.
So interesting. You like the chip makers, even though not exactly defensive.
No, what I'm saying is that there are high quality companies in every single sector. We are still positioned value over growth. We haven't completely exited growth. That would be a very big tax bill. Because let's also not forget, the S&P 10-year average is still 50% higher than long-term returns. The 10-year annualized return is 12%, whereas the long-term average is 7%. So our clients, your viewers, they're still, investing money that has had a huge run, even taking into account the downturn in 2022.
Holly, thank you very much. Good to get an update from you. You're not buying it, not buying the rally. Holly, Kroft, thank you.